If you're looking to get started in investing, then two terms that you should know are stocks and funds. In this video, we'll take a deep dive into each and discuss both the pros and cons. At the very end of the video, we'll talk about some of the funds that I own and why I think these are a safer alternative to stocks. So what are stocks? Stocks are shares in ownership of publicly traded companies. This means that when you buy a share of a company, you have partial ownership of it. You share in any of their profits or losses. Now, why do stocks exist? Stocks are a way for companies to raise capital without going into debt. What's important about this is that it allows the average individual to take a share in their profit. When you go on the stock exchange and you see the price of each stock, that's the price it'll cost you for one share in that company. The money companies get from issuing shares of their company is what they use to further the development of their company. This is why it's important for you to understand the companies that you're investing in. If you truly believe in their vision, then when the company grows and profits, you will too. Now that you know what stocks are, what are funds? And why do I think that this is less risky than stocks? Funds are a group of stocks that are either actively or passively managed. Three common types of funds are mutual funds, index funds, and exchange trade funds. Now, what's the difference between each? A mutual fund is an actively managed fund that contains a group of stocks chosen by a portfolio manager or management team. Because they're actively managed, mutual funds generally have a higher fee than an index or ETF fund. Index funds are funds that try to match the performance of the current indexes. Three big exchanges in the United States include the S&P 500, the NASDAQ, and the Dow Jones Industrial. The last type of fund I mentioned was an exchange-traded fund. ETFs, or exchange trade funds, are similar to indexes in that they try to match the returns seen on one of the three big indexes. The main difference is that they trade like stocks, so you can buy and sell ETFs throughout the day. And so now that you know what these are, what are some of the pros and cons? Stocks, the pros are because you're purchasing an individual company, when the stock price goes up, your value and your profits go up as well. However, when they go down, the same thing happens to you. Stocks are generally more risky than funds because you're purchasing an individual company. The pro is that the potential for returns are much higher than funds. How about index funds? What are the pros of index funds? The pros of index funds are that its growth tries to replicate that of the market. Historically, the markets on average have been growing at an 8 to 12% increase each year. Another advantage of index funds is that they're not an individual stock. There are multiple stocks in an index fund. This helps to diversify your portfolio and also help to mitigate risk. Unlike stocks, if the price of one stock goes down, the whole price of the index fund doesn't get affected. Now, what are some of the disadvantages? One of them is that there are fees associated with using index funds. However, one difference between an index fund and a mutual fund is that because index funds are known as passively managed, their fees are generally a lot less than mutual funds. Another disadvantage of mutual funds is that they have a high minimum entry. Some index funds require a minimum amount of $2,500. And now, what about mutual funds? Mutual funds, like index funds, have a group of companies within them. And so this is good because it helps to mitigate risk. And now, what are some of the disadvantages of mutual funds? One big difference in a mutual fund is that there are high fees associated with it. This will affect the overall ability for your mutual fund to grow to its potential. Another advantage of mutual funds is that most of them try to outperform the market. Because they're actively managed, someone is looking to beat the 8 to 12% returns that the markets are showing each year. However, this is also a disadvantage. Because mutual funds are actively managed, you'll generally see higher fees than that of index funds. And so what about ETFs? One advantage of an ETF is that similar to an index fund, it tries to mimic the performance of markets. However, one major difference and one big advantage of an ETF to an index fund is that they trade like stocks. Because they trade like stocks, this means that you can buy them throughout the day. The answer is it depends. It depends on many things, such as your risk tolerance, your age, and your overall knowledge of the market. If you're not that well versed in stocks, I'd say going for an index fund or ETF is the way to go. Because funds have many companies in their portfolio, it helps to hedge your bet. The other factor is age. Generally, the younger you are, the more risk you're able to take. That is because you have more time to grow your portfolio and to correct any mistakes that have been made. A good rule of thumb is subtracting your age by 100. That's the percentage of stocks that should be in your portfolio. If you're 30 years old, then your portfolio should be comprised of about 70% stocks. Regardless of what you choose, one rule of thumb is to have diversity in your portfolio. Whether or not you go for stocks or funds, you should be covering a wide range of sectors in your portfolio. Diversity in your portfolio will help to mitigate risk and to protect you from some of the current downturns in the market. Alright guys, so as mentioned, here are two funds that I currently have in my portfolio. For those of you that don't know, I'm giving you guys full visibility of my M1 Finance portfolio as a monthly update. I'll be giving you updates onto the current balance and what current stocks I own. Here you can see I have two funds in my M1 Finance portfolio. The first one is VTI and the second one is VYM. The reason why I said those two ETFs are good is because they have a multiple number of companies within them. That helps to mitigate risk. And so the way to find that is by going to the Vanguard website and typing in their ticker symbol on the top. From there, it'll take you to the ETF page where you can see more information about the stock. One thing that's noted here is the expense ratio is only 0.3%. And so to find out what companies are in this ETF, you go over to the Portfolio and Management tab, and then scroll down to see the portfolio holdings. As you can see, this is a total market ETF, so it's tracking the whole market. This current ETF has 3,505 holdings. And as you see here, you can scroll down and see all the different companies within it. The other ETF that I have is the VYM. VYM is the Vanguard High Dividend Yield ETF. Similar to the Vanguard Total Market, it has a very low expense ratio at 0.06%. To find out what companies are part of this ETF, go again into the Portfolio and Management tab. At the bottom, we go to Portfolio Holdings. And as you can see, because this is a different type of ETF, it doesn't track the total market. And so instead of having 3,505 holdings, this ETF only has 394, but it's still a good step in the right direction to help diversify your portfolio. The last fund I'll show you is the Vanguard Vt Si X. This is a great overall index fund because it tracks the total market. As you can see here, this also has a low expense ratio at 0.04%. As mentioned in my video, this requires a minimum investment to start. So unlike ETFs where you can buy one share at their current price, this you have to start with at least $3,000 before you can keep contributing to it. And so there you have it. Those are the differences between stocks, ETFs, mutual funds, and index funds. If you haven't yet, please like, comment, and subscribe down below. We're a new and growing YouTube channel, and your support really goes a long way to helping us provide quality content for you. One of the websites I showed in this video was M1 Finance. M1 Finance is an online brokerage tool that allows you to buy and sell stocks and funds. If you haven't yet, go check my other video as I give you an overview into the M1 Finance website. I also show you with full visibility all the stocks and my current balance. If you are looking to open up an account, please use my referral link down below as it gives both you and I $10 towards our investments. Until then, see you on the next one. Thanks for watching.